Have you ever stopped to think about what actually happens in that split second after you click the buy button on a stock? Today, we're going to pull back the curtain on a system that is way more complex and, frankly, way more conflicted than you could possibly imagine. We're diving into the market structure crisis. It's the question that just hangs in the air for every single trader. Is the stock market rigged? Now, our source material for this explainer doesn't use that exact word, but it does confirm that the market has developed these non-transparent asymmetries. It's a fancy way of saying the playing field is not level, not even close. So let's break down what that really means for you. You know, most of us picture trading as a pretty simple process. You see a stock, you hit buy, and you get the best price available, right? But what if I told you that simple picture is a complete fantasy? Yeah, we think a trade is a straight line, just like you see on the left. But the reality, well, it's a maze. The moment you click buy, your order isn't just sent to one central place. Oh no, it's routed into this chaotic ecosystem where it gets seen, analyzed, and acted on by the fastest computers on Earth, all before your order is even filled. And this is the core of the problem, fragmentation. The market is scattered across dozens of different exchanges, even more private trading venues called dark pools, and hundreds of other market makers. This fragmented, chaotic system creates the perfect battlefield for a certain kind of player, a place where speed is literally everything. So, who are these dominant players in this high-speed battleground? Let's meet the speed demons, high-frequency trading firms, or, as you'll often hear, HFTs. To put it simply, HFT is all about using technology to be faster than everybody else. And we're not talking a little bit faster. We are talking about speeds measured in microseconds. That's millions of a second. They use that incredible speed to exploit tiny, fleeting price differences across that fragmented market we were just talking about. Now, according to Haim Bodek, who is a key whistleblower on all of this, HFTs didn't just win by being smarter. He says it's about exploiting a system of artificial advantages that were built into the exchanges themselves. The system was basically designed to cater to them. So what does this HFT arsenal even look like? Well, for starters, it's about physical advantages. Like, they pay big money to put their computers in the exact same room as the exchange's servers. That's co-location. They also buy private data feeds to get information milliseconds before the public sees it. But their most powerful, most controversial weapon is something else entirely: special order types. And this is where the game gets really complicated. Because it turns out not all orders are created equal. There's a secret rulebook that most of us never get to see. Okay, so at the heart of this whole controversy is the idea that exchanges created a two-tiered market. For you and me, we get the standard orders, market, limit, you know the drill. But for their biggest, highest-paying HFT clients, they created a whole different menu with complex orders that have special hidden powers. And this wasn't some backroom conspiracy. It was literally stated policy. Back in 2005, the CEO of the BZATS exchange said right out loud that their goal was to create separate interfaces and trading paradigms, one for the HFTs and another one for everybody else. So what could these special orders actually do? Well, Bodek's research uncovered stuff like queue jumping. Imagine being first in line for a trade, and an HFT order can just cut in front of you. Others were like hidden traps, just waiting for a specific market trigger to trade ahead of the public. They were even designed to manipulate the entire fee and rebate system of the market itself. And that brings us to the economic engine that powers this whole thing. It's a pricing model that creates this tangled web of conflicting incentives. And it's called the maker-taker model. Okay, here's how it works real simple. If you place a passive order that adds liquidity, you make it, the exchange pays you a small rebate. If you place an aggressive order that removes that liquidity, you take it, the exchange charges you a fee. It sounds pretty simple, but trust me, the consequences are profound. Because this system creates a huge conflict of interest for your broker. See, they have a legal duty to get you the best price, the best execution. But their financial incentive might be to chase the biggest rebate for themselves, even if that means sending your order to a place that gives you a worse price. Michael Lewis, in his book, Flash Boys, which is cited in our source, put it a little more bluntly. He called this whole system of fees and kickbacks a way for Wall Street to get paid to, quote, screw the investors whose interests they were meant to guard. So, after hearing all that, it is so easy to feel like the game is stacked against you. But understanding these invisible rules, that is the first and most important step to leveling the playing field. Knowledge is your best defense. It's your only defense. So let's just recap what we've learned. The market isn't one place. It's a fragmented web where speed is a weapon. Secret order types have given insiders an unfair edge, and the whole system is driven by incentives that probably don't have your best interests at heart. The key here is to always question where your order is going and why. Ultimately, the market is a game of information, and you cannot win a game if you do not know the rules. So the real question isn't whether the market is rigged anymore. It's, now that you've seen behind the curtain, how will you choose to play?